Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Tuesday the 5th of February 2019. I'm Darren Sinden and you can follow me throughout the day on Twitter using @DS_Pepperstone. Okay, let's kick off with a look at the overnight changes and price moves to be aware of. Relatively quiet for European majors yesterday. The euro and the pound sterling both largely unchanged against the US dollar, but there were gains overnight for the Australian dollar and the New Zealand dollar. The Aussie dollar clawing back 0.57% against the US dollar, and now up by around 1.5% over the course of the last week. As I say, there are gains for the Kiwi too. The Chinese yuan was also on the front foot against the US dollar despite the Chinese Lunar New Year, and the yuan gained by 0.22% against the greenback in the last 24 hours. The dollar made headway against the Brazilian real, which has been amongst the strongest currencies of late. The dollar took just 0.25% off of the Brazilian real, but small gains, I suppose, can mount up in the end. Dollar index, for its part, completely unchanged on the session, 95.83 trading before we recorded the video, and as I've said several times in the month of February and in late January, this is really the dollar telling us that it's looking for directional cues from either the Fed or the wider market. Just really not sure what it wants to do from here. Okay, what's on the calendar then? Events that may move the markets today. Well, we've already had some pretty important data out before we recorded the video. First thing this morning, a minute past midnight, we had like-for-like retail sales out of the UK and a much more impressive number than was forecast there, so a boost for hard-pressed UK retailers. We had a speech earlier this morning from FOMC member Meister, that was at 12:30 GMT, and at the same time we had the release of retail sales and trade balance data for December out of Australia, but all of that was overshadowed at 3:30 by the Reserve Bank of Australia interest rate meeting decision and statement, and we'll look at that in a bit more detail momentarily. To come then in Europe at 8:15 GMT, we'll have market services PMI for January out of Spain, and that'll be followed at 8:55 by similar data out of Germany, and then at 9 o'clock the composite PMI data out of the whole of the Eurozone for the month of January, obviously composite PMI being a combination of manufacturing and services PMI. At 9:30 we'll have the last leg for the UK, the market services PMI January data. Obviously had construction PMI data yesterday and manufacturing last week. And then at 10 AM GMT we're back into Europe for retail sales year on year for the month of December. We paused then until 14:45 this afternoon, crossing over the Atlantic for composite and services PMI data out of the US for January. And at 1500 the last piece of the jigsaw puzzle as far as PMI data in the US is concerned, with the release of the ISM non-manufacturing PMI for January at 1500 GMT. Okay then, breaking news and comment that's caught my eye overnight. And first of all, the Reserve Bank of Australia kept rates on hold for the 30th month in a row. The bank acknowledged the risks to the Australian economy, and those risks tend to lie to the downside, but it declined to shift its bias towards rate cuts, and that's a big relief for the Australian market, with up to 50% of money market participants believing that some sort of rate cut could happen by November this year. Hopefully that will readdress that balance and swing things back round to at least a neutral stance, slanting hopefully to the bullish side if the economy picks up. Meanwhile, Japan's service sector January PMIs printed at 51.6 versus 51.0 in December. New business unemployment grew, or the new business unemployment components of that figure grew, but perhaps rather concerningly, the backlog in the sector continued to grow due to a lack of capacity, and that probably speaks to some of the constraints of the Japanese economy: a very tight labour force, an ageing population, maybe just a lack of skilled people to drive growth and opportunity in the service sector there. Meanwhile, US President Donald Trump will make the annual State of the Union address later today, focusing on his key issues as he does so. And just to remind you what they are currently for him, they are the wall, immigration into the US, healthcare and infrastructure projects. Right then, food for thought, something to take away with you into the trading day and beyond, and why not think about this? The caption here, looking forward in the S&P 500, and of course if we look at the S&P 500 index itself, the US 500 index, we all know the story here, trending lower throughout the autumn of last year, and then a sharp sell-off into the holiday period. Markets got particularly bearish here, as you can see, and then a bounce and a realization that perhaps the Fed was not going to tighten rates as quickly as was previously thought, and we saw a sharp and continued rally in the S&P 500 throughout December into January and into early Feb, taking out the downtrend line that we've drawn there from the October 2018 highs. Now that's all well and good and very interesting. However, at the same time that the equity market was rallying, analysts' estimates over earnings for the first quarter of 2019, that's the first 3 months of this year, have been trending lower. And so as the market rallied, expectations about what was going to happen to earnings and the multiples that share prices would be on going forward were drifting lower. So something of a disconnect here between the two. One of these charts is probably telling us which way the market's going to be headed. One of them's probably wrong. I'll leave it to you to try and work out which way round that is, but certainly something to be aware of and take away and think about. Okay, please take a moment to read this risk warning. Trading CFDs and foreign exchange on margin can be a risky business. If you're in any doubt about those risks or the suitability of leveraged products for you, then please do contact your Pepperstone account representative, and do take the time, as I say, to read this risk warning thoroughly. Thank you for your time today.